Most people think investing is a game reserved for the wealthy. They imagine stock traders in expensive suits, managing millions of dollars from towering offices. But here is the truth that nobody talks about enough. The biggest advantage in investing has nothing to do with how much money someone starts with. It has everything to do with when they start. The investors who build the most wealth are rarely the ones who started with the most. They are the ones who started the earliest, even with almost nothing. That is the hidden advantage most people completely overlook. Why small beginnings hold enormous power? There is a force working silently behind every great fortune, and it is not talent, luck, or a high-paying job. It is compound interest. When money is invested, it earns returns. Those returns then earn their own returns, and those returns earn even more returns. Over time, this cycle does not just add wealth, it multiplies it exponentially. Think of a small snowball placed at the top of a long hill. At first, it barely moves. It picks up a little snow, then a little more. But as it rolls further, it grows faster and faster. By the time it reaches the bottom, it has become something enormous. That is exactly how compound growth works in investing. Here is a simple example. Someone invests just $1,000 at an 8% annual return. In year 1, they earn $80. In year 2, they earn interest on $1,080, not just the original amount. That extra few dollars might seem meaningless, but over 20, 30, or 40 years, the gap becomes staggering. Warren Buffett is one of the most studied examples of this principle in action. He did not begin his wealth journey with millions. He bought his first stock at just 11 years old. By 20, he had already been investing and reinvesting for nearly a decade. Buffett himself has credited compound interest as one of the central forces behind his wealth. He did not wait until he was rich to start investing. He started small, started early, and let time do the heavy lifting. This is precisely why starting small is not a disadvantage, it is a strategy. The investor who puts away $200 a month starting at age 25 at an 8% return could accumulate nearly $700,000 by retirement. Someone who waits until 35 and contributes the same amount every month ends up with roughly $300,000. The difference is not about the money contributed, it is about the years lost. A 10-year delay can nearly cut the final result in half. The psychological advantage nobody mentions beyond the math. There is something even more powerful about starting small, the mindset it builds. When someone begins investing with a small amount, the emotional stakes are low. There is no paralysis, no fear of losing life savings, and no pressure to make perfect decisions. That low-pressure environment creates the perfect space for learning. Investors who start small get to make mistakes while the cost of those mistakes is still manageable. They learn how markets move, how to handle downturns without panic selling, and how to stay consistent when everything around them feels uncertain. By the time they have more money to invest, they already have experience and discipline. Ashton Kutcher is a well-known example of this mindset in the celebrity world. Before he became one of the most recognized tech investors in Hollywood, he started paying close attention to small investment opportunities early in his career. He did not wait until he had massive wealth to begin. He studied, started modestly, and eventually built a portfolio that included early stakes in companies like Airbnb and Uber, investments that multiplied enormously in value over time. Rihanna's approach to building her business empire, Fenty, also reflects this principle. She did not launch everything at once with unlimited capital. She started with calculated, targeted moves, grew her brand's financial base, and reinvested consistently. The result was a billion-dollar business built with compounding discipline. Starting small also removes the dangerous habit of waiting for the perfect moment. Many people delay investing because they believe they need a large lump sum to begin. They wait for a bonus, a promotion, or a market dip. In the meantime, months and years pass. Every year of delay is a year of compound growth that can never be recovered. The market will always have uncertainty. The only certainty is that time passes regardless of whether someone is invested or not. Dollar cost averaging is one of the best tools for small investors. Instead of trying to time the market, an investor puts in a fixed amount every month, regardless of whether markets are up or down. When prices are low, they automatically buy more. When prices are high, they buy less. Over time, This strategy smooths out volatility and builds a growing position without requiring market expertise or large capital. How ordinary people turn small investments into real wealth. The most overlooked investors are not the celebrities or tech billionaires. They are everyday people who quietly began investing small amounts in their 20s or 30s and never stopped. Their stories rarely make headlines, but their results are just as remarkable. Consider the power of $100 a month invested consistently from age 25. At a 7% average annual return, that person would accumulate over $260,000 by age 65. They would have contributed only $48,000 of their own money. The rest, more than $200,000, would have been generated purely by compound growth. Kyle, a name used to represent countless real-world examples.
The probabilities that they would dominate the soft drink market and not lose market share in any way, that they would grow over time,
started putting $50 a month into an index fund at 22 after reading about Warren Buffett in a magazine. He never earned a six-figure salary. He never made a bold stock pick or took a huge risk. He just stayed consistent, reinvested everything, and let decades work in his favor. By the time he retired, his account had grown well beyond what most would expect from such modest contributions. Index funds have become one of the most popular tools for small investors because they require no expertise, carry broad diversification, and historically deliver steady returns over the long term. Broad market index funds have averaged around 8% annually over extended periods. That is the vehicle. Time and consistency are the engine. Kevin Hart, the comedian and entrepreneur.
Real quick. Just real quick.
You gonna FaceTime somebody?
Yeah, I just forgot to tell one person.
Who are you gonna FaceTime?
Just a close friend of mine, somebody I'm very close to. You may know him.
Has spoken openly about learning financial discipline early in his career. Even during his early years when income was inconsistent, he developed habits around saving and investing small amounts. He has often spoken about the mindset shift that occurred when he stopped viewing investing as something only wealthy people could do and started treating it as a non-negotiable habit. The lesson across all of these examples is the same. Wealth is not built in a single moment of inspiration or one genius investment decision. It is built through repeated, disciplined action over a long period of time. Small investments made consistently grow into something much larger than most people dare to believe. There is also an important emotional truth here. Starting small creates momentum. The act of investing, even $10 or $20, changes the way a person thinks about money. It creates a sense of ownership in the future. It turns passive earners into active builders. And once that identity shift happens, it tends to grow alongside the portfolio. The hidden advantage of starting small is not really hidden at all. It has been demonstrated by some of the wealthiest people on the planet and confirmed by decades of financial data. The advantage is time, the strategy is consistency, and the entry point is wherever someone happens to be right now, not next year, not when the salary improves, not when the market looks more stable. The best time to start investing was 20 years ago. The second best time is today.